Stocks are a portion of ownership in a particular business. Let's say you have a relative who starts a business, and then she actually wants to raise some equity. She may go to her family members and tell them, I have this good idea, take a stake in this particular business. So she will give, well, it started with her, so that's 100%. And when she starts to give it to her fellow relatives, each now takes a stake in the business. In return, she gets money to go out and expand the business. Now, it gets a little more expansive when you look at it when it's listed. Let's take a case in point, Stanbic Bank, when it did its IPO in 2007. It decided to list 20% of its shares to the public. So that is an invitation for people to come and own a portion of the business. And when the company profits, you also are paid a dividend, which is a return for you as a shareholder. Two things. You've got to understand the company, what makes the company tick, the corporate governance. Is there something unique about this corporate governance that will make the business successful? You've also got to understand the product. Do people want this product? Do they have, when I mean economic moat, do they have protection against competitors? Are they good at servicing this particular market? And are they profitable in one way? So if you also understand how the company works and the sectors, then that is a good beginning. Of course, you would have to look at the financials of the company to actually prove that the company is profitable. Then the other aspect that you need to understand is the market. How does the market perceive the company? If the market perceives the company to be profitable, to be growing, to have the ability to capture a bigger market share, then the market starts to pay a higher price for this share. It's a great question. You'd actually have to go to intermediaries. These are licensed stockbrokers, licensed by the Capital Markets Authority. In Uganda, we have, I think, 6 of them that are licensed. When you walk into them, you tell the stockbrokers that you're looking to buy shares. It's their obligation to also give you the information of the company and the market. If you buy, let's say, Stanbic Bank at the price of, let's say, 150, and then at the end of the year, that particular stock price has moved up, let's say, 200, that 50% gain will come from people willing to buy more and more of this particular share, and those who are selling feel that you should pay a premium for that particular stock. So if you sell at, let's say, 200 shillings, you will then get the 50 shillings gain over and above the 150 that you invested. So that's what we call capital gain. In certain markets, this capital gain can be much, much more. But that is the driving principle on the capital markets. The other alternative to also gain is what we call dividend. Again, we talked about owning Stanbic Bank. And Stanbic, I believe, paid out a dividend this year of 1.7 shillings. Now that is a portion of the profit that the company made. If the shareholders and the directors feel that we're going to retain maybe 60% and pay out 40%, it's that 40% that is given out to the people who have shares. So the more shares you have, the more dividend you actually can benefit from. Well, when it comes to buying shares, I believe the minimum number of investment one should have is around 50,000 shillings. So we who have been in the industry keep encouraging people to acquire a bad habit of buying shares. When you start buying the minimum number of shares and you start to see the return on your capital gain or the dividend, you then are encouraged to pay more and more.